The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal.
And that's exactly why the Federal Reserve decided not to cut interest rates today. Basically, they need to see more good data about the economy to prove that inflation is in fact under control and can reach and then stay at the goal of 2% inflation. But the Fed chair did give us some hints about when those interest rates are going to start coming down. So I'll explain all of that in a second. But first, I want to thank my subscribers for overwhelmingly voting for this as the bonus story this week. If you want to vote too, you can always subscribe during my next live event, which is tonight at 9 p.m. Eastern, or you can just follow these steps and you can subscribe right now. All right, so here's what's happening with the economy. The Federal Reserve decided to keep interest rates steady at 5.25% to 5.5%. The good news is the Fed chairman, Jerome Powell, says as long as the economy doesn't do anything wild, those interest rates will probably not go any higher than that. Good news. So the real question is, when will the Federal Reserve start to cut those rates? Well, first, Chairman Powell explained that whether you actually feel it or not, all the indicators show that this is a super strong economy.
Growth is solid to strong over the course of last year. The labor market, 3.7% unemployment indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy.
Now, while that's all good news, it's not enough. The Fed is concerned if they cut interest rates too soon, we could just see inflation spike right back up. And if the Fed cuts rates too late, it may cause a recession. So to avoid either of those things happening, they say they just need more of the same good data.
It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, a sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data.
The Fed chair said it is possible we could see as many as 3 interest rate cuts this year. But because all the economic data is coming in really strong, those rate cuts probably will not happen in March the way the Fed originally expected.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, right, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.